Here's the full 15-minute premium explainer script, paced for retention and narrative flow. The market didn't move because of numbers. It moved because people felt something. Confidence, fear, relief, panic. Every major boom and crash in history looks complicated on paper. But underneath the charts, the formulas, and the jargon, there's a much simpler engine running the entire system. Markets follow confidence loops. And once you see the loop, you can't unsee it. Because prices don't rise first. Belief does. Right now, this matters more than ever. Trillions of dollars move every day based on expectations about the future. Not the future itself. Just stories about it. Stories told by analysts, CEOs, politicians, central bankers, and social media feeds. And when enough people believe the same story, it becomes real. At least for a while. That's how bubbles inflate. That's how crashes accelerate. That's how markets disconnect from reality and then violently reconnect. So let's slow this down, strip it of jargon, and look at what's actually happening. At its core, a market is just a giant guessing machine. People guess what something will be worth tomorrow. Then they place bets today. Stocks, housing, crypto, bonds, even currencies. Same logic. If you believe prices will go up, you buy. If enough people buy, prices go up. When prices go up, confidence rises. And when confidence rises, more people buy. That's the loop. Belief creates action. Action creates results. Results reinforce belief. It feeds itself. At first, the loop is grounded in reality. Company is growing. Profits are improving. A new technology actually works. But then something subtle happens. Confidence detaches from fundamentals. People stop asking, is this worth the price? They start asking, will someone else pay more? That's when markets stop being calculators and start being mirrors. They reflect emotion back at themselves. You can see this clearly in the language people use near the top of a cycle. This time is different. The old rules don't apply anymore. You just don't get it. Those phrases are warning signs. Not because people are stupid, but because confidence feels safest when it's shared. No one wants to be alone in doubt while everyone else is celebrating. Confidence is contagious. So is fear. And markets don't just follow confidence. They amplify it. Here's where the math gets uncomfortable. Imagine an asset priced at 100. Optimism pushes it to 120. That 20% gain becomes proof that optimism was justified. New buyers enter. Not because the asset changed, but because the chart did. At 150, nobody talks about risk anymore. At 200, risk is dismissed as negativity. At 250, caution sounds stupid. This is how valuation models quietly exit the room. The market doesn't ask permission from reality. It borrows credibility from momentum. And momentum feels like truth while it's working. This isn't new. In the late 1990s, companies with no profits were valued higher than companies with real cash flow. Why? Because prices kept rising. The rising prices were the evidence. In the mid-2000s housing boom, people believed home prices couldn't fall nationally. Not because of deep analysis, but because they hadn't fallen yet. Confidence loops don't need facts. They need reinforcement. Every uptick says, see, it's working. But here's the problem. Confidence loops are fragile. They look strong because they're loud. They feel stable because they're crowded. But they rely on a single assumption. That confidence will continue. The moment confidence hesitates, the loop reverses. And reversal is faster than ascent. When prices stop rising, belief cracks. When belief cracks, buyers hesitate. When buyers hesitate, prices fall. When prices fall, fear spreads. Same loop, opposite direction. This is why crashes feel sudden, even though the warning signs were visible for months or years. Confidence doesn't fade gently. It snaps. One missed earnings report. One interest rate hike. One political shock. One headline that forces people to reprice risk at the same time. And once fear enters the loop, logic disappears again. Assets don't fall because they're suddenly worthless. They fall because confidence is unwinding. Everyone rushes for the exit, not because they've calculated intrinsic value, but because they assume everyone else is about to run too. Markets don't panic individually. They panic socially. This is where central banks enter the story. Because modern markets are not just confidence loops. They are managed confidence loops. Interest rates, liquidity injections, emergency statements, these aren't just economic tools. They're psychological tools. When a central bank says, "We will do whatever it takes," markets often rally instantly. Not because conditions changed overnight, but because confidence was patched. Money printing doesn't always stimulate the economy, but it almost always stimulates belief. Belief that liquidity will remain. Belief that risk will be backstopped. Belief that prices will be defended. This creates a strange irony. The more markets rely on confidence support, the more sensitive they become to any hint that support might be removed. Low rates boost confidence, but exiting low rates threatens it. So the system becomes addicted to reassurance. And investors learn a dangerous habit: buying not based on value, but on expected intervention. That's when confidence loops start feeding on policy, not productivity. The hype gets louder, the math gets thinner, and eventually reality asks for payment. It always does. Not immediately, not predictably, but relentlessly. At some point, cash flows fail to justify prices. Debt becomes expensive. Growth slows, or confidence simply runs out of new buyers. And when that happens, the loop doesn't gently unwind. Collapses under its own weight. This is why the most dangerous phrase in markets is, "everyone knows." Everyone knew tech stocks would keep rising. Everyone knew housing was safe. Everyone knew rates would stay low forever. Markets punish certainty more than ignorance, because certainty removes margins of safety. Here's the uncomfortable truth. Markets don't reward intelligence as much as they reward timing within confidence cycles. You can be right and still lose money if confidence turns against you first. You can be wrong and still make money if belief carries you long enough. That doesn't mean fundamentals don't matter. It means fundamentals matter eventually. Confidence decides the schedule. So what do you do with this? You stop pretending markets are rational machines, and you stop pretending they're pure chaos. They are emotional systems with math layered on top. They swing between fear and belief, exaggerating both. The key isn't predicting the next move. It's recognizing where confidence is being manufactured, borrowed, or stretched. When confidence is cheap, risk is expensive. When confidence is expensive, risk is hidden. And when everyone feels calm, that's usually when the system is most fragile. Because confidence loops don't break when people are scared. They break when people are comfortable. So here's the thought to sit with. If markets are driven less by reality and more by belief, if prices are signals of confidence, not truth, and if confidence itself is shaped by stories, policy, and momentum, then the real question isn't what the market is worth. It's this: what story is everyone believing right now? And what happens when they stop believing it at the same time?